Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, November 18th, 5:03 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the Big Show, the Friday edition of the Revere Market Insight video, where we take a look back at the prior week, take a look ahead at what you need to know for next week, and update the world famous 21 over 21 list, which you can only get here at Revere, home of the Flying White Horse. Let's get right into it. State of the market, bear market rally. You can see over here on the trend gauge, market leaders acting just fine. I could have kept the 21 over 21 intact from last week, and that's a key to you that and to me that leadership is just fine. But we bought two stocks that weren't on the list during the week, and we always want to have them in there. And I have a reason for cutting the two that I did, and we'll discuss that when we get to it. Short term, all five of the major indexes are above their 21-day exponential moving average, also above their intermediate term 50-day moving average. Long-term 200-day moving average is a different story, but we're getting closer, much closer. Mid caps tested and held the 200-day this week. Dow didn't even test it, stayed firmly above it as it just spent a week consolidating. Small caps broke below it. Large cap S&P 500 just approaching it, and the Nasdaq 100 not so much, still lagging as those big FANG type stocks are still an overhang on the market. So what just happened? Red week, but I think it's a win for the bulls after last week. Last Thursday, we had that massive 3.8% gap up after weak inflation data came in. We ended up closing that day up 5.5% on the S&P, 7.4% on the Nasdaq 100. By the way, we didn't get all those gains, and the only people that did get those gains are the people that rode the index down the entire way and stayed in to be able to get those gains. So that's the time that the buy and holders trot out the tired old, see, you have to stay in or you missed the best days in the market, and your returns are just terrible if you miss the best days. Well, they don't mention all the terrible down days that went in to the market being down 27.5% at one point year to date. They just conveniently forget that fact. Volatile markets occur under the 200-day moving average, and the good days and the bad days are sandwiched with each other. You can't get the good days without getting the bad days, and vice versa. But I digress anyway. Bottom line, win for the bulls. Big gap up last week, follow through on Friday, and a nice consolidation. I'll hand it to the bulls. These types of numbers on a pullback after what we saw on Thursday and Friday is definitely a win, especially in the S&P 500 holding that 3,900 level. So two columns here. First is what we did today. Second column is what we did for the week. G6 finished barely negative on the day for the week, down 3.2%. S&P 500 today gapped up 0.85%, very bullish overnight, but that was it. High for the day put in the first minute. And then we just formed a big cup the rest of the day. Strength came in near the end of the day, a little bit of a pullback right in the last couple of minutes as there was some options expiration jostling, as always happens. For the week, S&P down 0.7%. Nasdaq 100 just barely positive on the day, lagged all day, was red most of the day after its initial gap up of 1%, so it really gave a lot back. For the week, down 1.1%. Dow up 0.6 on the day, just barely negative on the week. Mid caps up 0.6 on the day, down 0.85 for the week. Russell 2000 small caps up 0.6 on the day, down 1.8 for the week, the weakest of the major indexes. Global diversified 60/40 stock and bond barely positive on the day, up 0.05, down 0.24% on the week. Our in-house GROTECTION portfolio on the day up 0.16%. On the week, down 0.18%. We're in that survival mode process where we're coming off the bottom. We're above the, and when I say we, I'm talking about GROTECTION. We're above the 21 and the 50-day moving average. Strength is still being sold. It was sold all week, but weakness was also bought. So you can get chopped up if you buy strength and then end up selling weakness. So we're trying to avoid that as much as possible. Not a lot of trades actually this week. We're just trying to keep our beta between 0.6 and 1.0 until we get back above the 200-day moving average and some more leaders, strong leaders, come to the forefront. So we'll do the tail of the tape and the updated 21 over 21 list after this pause for a brief commercial message. What do we do at Revere here? People probably tune me out for the next 2 minutes because they know, but we are a conflict-free registered investment advisor, fee only, fiduciary. That means we always act in the best interest of our clients. Registered with the SEC, that means we manage more than $100 million. Our flagship portfolio is called GROTECTION, designed to grow assets during uptrends and protect them during downtrends. We manage individual client accounts. It's not a hedge fund. It's not a mutual fund. Everybody can log in individually and see their balance. We do this thing called block trades, where if we want to take a certain percentage, we just multiply all the assets by that percentage, by that number of shares, and then the software spreads it out to everybody's account based on the size of their account. You have access. We don't custody the assets. They're at TD Ameritrade or Charles Schwab. Everybody has full access, and everything is fully liquid all the time. Based on the action of leading stocks and the trend gauge that I showed on the prior page, that dictates how much exposure we have to the market. A perfect scenario is last October, November, where we're trending higher above all three moving averages. If we start to go sideways, our stops will take us out of the market. If we start to trend lower, you'll see the slopes of the line go down. And then if things start to get really bad, we'll break below this nasty black line. That's the 200-day moving average that you should make sure that all of your friends and family members are fully aware of this chart right here. The last 13 bear markets, if you're approaching retirement and you don't want to have half of your nest egg disappear because the market is decided it's time for a pullback, show them this and then have them call us. We'll discuss it with them. It's never too late to sell as long as you have a plan to get back in. That's another derisive thing that the buy and holders like to say about people that actively manage. You have to be right twice. You have to get out and then you have to get back in. Well, we've got a set of rules. Anybody that's been with us for a long time knows long-term the rules outperform. We get big crisis alpha when the market is trending lower. We get alpha when growth stocks are outperforming, such as late 2020. And the rest of the time, we're kind of in sync with the market, give or take a couple of percent here and there. And if you're interested in this approach, give us a shout. You can email me, don@revereasset.com or dan@revereasset.com. That's my partner, Danny Stewart. He's a CFA, president of Revere, king of all things financial. If he doesn't know the answer, he knows who has the answer. Or you can call us on 855-REAL-WEALTH. That's 855-732-5932. So talking about getting back in, we've been following our reentry rules since this shakeout at the bottom. 2 CPI reports ago put in the bottom for now. We've been basically taking 2 steps up and 1 step back, almost 2 steps back here. We got stopped out of a couple of things, but again, it was a sign of weakness that was bought up. And that was on Jerome Powell's FOMC meeting where he really talked tough, but the market responded with the latest CPI report. Big gap up. That's the gap up day. 4 days of tight consolidation. Yesterday, a little bit of a test for the bulls. The bears failed, though, and the bulls took the ball back today. Let's take a look on a 60-minute chart, which I've been using to clearly show this 3,900 area and this 3,950 area, which provided support for 4 days going into yesterday, where we failed 3,950 but held 3,900. Then today we gapped back above 3,950. But of course, it can't be that easy. You look on a 5-minute chart here, you'll see a big cup formation. Got above, got back below. Anytime we came around 3,950 here, it was time for ping pong. We're above, below, above, below, above, below, but then a nice rally into the close got us back above before some give back the last couple of minutes. But all in all, I'm calling this a win for the bulls with the reclaim of 3,900. Now next week we want to look for a challenge of 4,007, which is a fib level, 61.8% of the difference between the recent high and the recent low, this leg down. And also right above there is the 200-day moving average, which is currently at 40.67, dropping about 3 points a day. If you go to the weekly, the 40-week, the corresponding 40-week is down at 40.51, and it'll drop lower next week. So we may touch the 40-week before we touch, well, we will touch the 40-week before we touch the 200-day, and we'll be wary of both of them to see what happens here. You can see back here on 8/16, we didn't quite get to the 200-day moving average, but we did touch it that week on the 40-week, and we're rejected there. So we'll be paying close attention to both of those levels. A move there with some strength that then pulls back, tests it, and holds and takes off again will be a very bullish scenario for the market. So that's the S&P 500. Let's go to the NASDAQ 100. I've been saying that 285 is the equivalent of 3950 for the NASDAQ 100, and we failed. 285, you can see here, got above it on the second day of the rally last week, back below it on Thursday, tested it, failed, gapped above it, failed, and didn't quite get back above it into the close. In fact, we just gave it up really the last couple of minutes. So arguably, you could say we closed right on 285, which is kind of this key level. So all in all, not bad, but the big cap tech stocks are still lagging. You can see relative strength waned over the last 3 days on the NASDAQ 100 relative to the S&P 500. We're holding these moving averages, the 21, the 50, and the 8 are all clumped together here. The 8 is basically in the vicinity always of the 10 simple moving average, but we bounced there Thursday and held it Friday, and that's a big plus for the markets also. Let's go to the Dow Jones Industrial Average, which led but didn't participate as much in the big gap up day. That's because that big gap up day was dominated by tech stocks and beaten down Cathie Wood type stocks. That ARK K fund of hers was up 24% in 2 days, but it was down 9% this week. That's just kind of leaves me speechless a little bit. But anyway, so what's the Dow doing? It's just biding time here. Loss of relative strength for 4 days, gained it back over the last 3 days. This is the leading index, just pulled back and held its 8 EMA, which it got extended from far more than the other large cap indexes did, but this is looking good. Bulls want to see this break above this 34,000 level. Let's go to mid caps, which pulled back, looked like they were going to lose the 200-day moving average, but they did not. Bounced on Thursday, follow through on a bounce off the 8 EMA today. Nice consolidation here after the big move up, and really you can say that about all the major indexes. Here's small caps, kind of disappointing on the week. You can see the negative relative strength line did pull back, failed at the 200, so 3 consecutive closes now below the 200. And when we failed into the 200 this morning, we shortly after that sold our UWM position. Even though we are holding the 21 and did bounce, we wanted that to be back above the 200-day moving average. It was not, so we went ahead and sold that for a small loss also. So those are the major 5 indexes. Let's look quickly at the equal weight. S&P 500, hey, closed right on the 200-day moving average after giving it up yesterday. That is just more evidence that the big cap, the overweighting at the top of the S&P and the NASDAQ is what's dragging them down. You can see here, this is the equal weight NASDAQ 100, much closer to the 200, bounced at its 8 EMA. How'd the dollar do today? Still in this tight 6-day range, up slightly on the day. It's very oversold. This is a cautionary tale for the market because, and then granted, oversold can stay oversold for weeks at a time. You can see several weeks here, just about a week here, and here, but definitely need to be cautious of how oversold the dollar is, as dollar strength has corresponded with market weakness lately. How did the VIX do? Lately, lady. The VIX was down today, 3.5%. So recall I was concerned about how oversold the VIX was and the bounce that we were expecting. Well, we got the bounce, and it worked off the oversold condition, and really not a lot of damage done to the markets. With you had the big gap up in the markets, and a spike up this week in the VIX, but did close near the lows for the week, and we rolled back over on the stochastic, which is a positive for stocks. We're below all the moving averages, and we're below that 24 level. So that's good for stocks also. How about gold for the week? Dollar up, gold down. That's kind of the script, rolling over from overbought on the stochastic, sitting on the 8 EMA. How about Bitcoin? Sam Bankman-Fried just won't go away. Let's look at this on a 60-minute chart. You can see the big free fall here, just consolidating for most of the week. Gave up that one gap up week, gap up day on Tuesday, really just consolidating with an upward bias. But this could also be a bear flag on Bitcoin. Let's go to bonds, TLT. TLT down on the week, which means interest rates up. Let's go to TYX, the 30-year, up just a little bit, hanging right on this 50-day moving average in oversold territory. This is another minor concern for the bulls, as rates up has meant stocks down. How about the 10-year TNX? A little bit of a bounce today, coming off of oversold. Really, what we've got, the declining 21 and the flattening out 50. You want to see what happens next week when it comes into those moving averages. It's very similar to what's happening with the pullback to the moving averages on the major indexes. This is pulling up into its declining moving averages on the TNX. And then also we want to take a look at junk bonds. Sometimes they sound an alarm. They were up on the day and really just consolidating along with the market. So no real big signals given off there. Let's go to the tail of the tape, and then we'll do the 21 over 21. I didn't get the put call numbers. Got to pause for a second. Okay, put call at 0.90, which is neutral. VIX, as I said, down 3.4%, 2312. Fear and greed down 1 to 62. We're operating under the the bull case. Bears are failing. They tried starting with 11.2, starting with Jackson Hole on 8.26, then CPI on 9.13, then the payroll report on 10.7, then FOMC on 11.2, and the bulls have survived all four of these events. Bit of news, home sales fell for the 9th straight month, down 5.9% month over month. Day count, we went from down 1 to up 1. My expectations are positive as long as we're over 3,900, which held, and plus we got back above 3,950. You can see here the gap up over the support resistance level, and then an undercut and reclaim of that 3,950 level is a positive for the bulls. As far as the NASDAQ 100 goes, gapped above this fib 286.82, and then we failed at it, but the 285, you got this 285 right before this fib. I don't have it listed here, but basically we closed right on that. Gapped up 8.85% on the day, but that was the high of the day. Then we formed an all-day long cup, including that 39.50 undercut that I mentioned. Our range was 39.36 to 39.80. 39.80 was the high of the opening 30.60 and below the overnight high. So basically our entire day range was within the overnight range also. Dollar up, banks up, value stocks led growth stocks today pretty much all day out of the chute, and with staples, utilities, healthcare, and real estate leading the way. Bonds down, oil's weak all day. CKY, that's Chucky, either lagging in relative strength or just down on the day, as a case of XLC. Software weak, solar's weak, coal weak, and gold weak. Here's the focus stocks. All of these are in the 21 over 21 list with the exception of Apple, and we'll look at that really quickly. On the portfolio, we took SPXL from a 3.3 up to a 10% position. That's the equivalent of about 30% long the S&P. We did sell UWM, that's our small cap. when it failed into the 200-day moving average, and we added Celsius to the portfolio. Bottom line, red week is a win for the bulls as key support holds. That's the bottom line, and see what happens when next week comes up. So let's take a look at Apple very quickly. Really, it paced as in it led the big NASDAQ stocks for most of the day. NVIDIA down again 1.7%, but SOX was up again on the day. You can see Apple will get to the 200-day moving average before the NASDAQ 100 will, and we'll see what happens when it gets there. You really do need Apple to do well. Note its relative strength over the last week and a half, which is pretty interesting because it didn't give back any relative strength this week, although that QQQ did. So Apple definitely money flown into it, and you can see from the higher blue bars versus the lower red bars, definitely some confidence being shown in Apple despite the bad news of the shutdown in Appletown over in China, where they make the iPhone, and they said that's going to make the models harder to come by, but Apple's Apple, and people trust it. So there we go with Apple. Now let's go. Oh, let's also add to SARK in case if the market goes south, ARK-K will go south also. Let me reinstate my alert for SARK. This is a pretty easy way to make money when the market's going down. If the weakest stocks are being sold, which has been the case all year. So let's get to the 21 over 21 list now, and let's start off with what was dropped. The two stocks that were dropped, NBIX was weak all week, but honestly ended up having a support week. I wrote it off earlier in the week with these. I don't like, and it's a support week from relative to where it closed. Undercut 3 days of heavy volume selling, undercut the 21, bounced at the 50-day. That's great. Back above the 21 today, but the two bounce days are much lighter than the 3 selling days, even though it is above the 21. That's not the type of action that we want to see, but it is the type of action that you see all the time in bear markets. And then Arch Coal. Coals are all over the place. Basically closed right on the 21, but it was the weakest of the remaining holdings in there, and it was replaced by something that we bought. And speaking of what we bought, let's get to the 21 over 21 now. Celsius we bought today. You know, I've been watching it. It's been on the focus list all day. It pulled back to the 80 MA today, and that's where we took our position when we saw that bounce off of there. And I think we're just about even on this one, but I like the way, you could argue that this is a bear flag with it going up on lighter volume, but you typically see volume taper off after the event day, in this case, which was earnings. We closed at the low of the day, and it hasn't given up. This could go either way, but as always, low risk entry point. If we're wrong, we'll be wrong small. 2% position, no, 1.5% position because of the volatility. And we'll be out with 0.1% loss to the overall portfolio if our stop is hit. So a little bit lower size versus our normal 2% because of the volatility. Next one up is GFS, which we added to. We took a position this week on Monday and added to it on Wednesday, closed at the high of the range for the day. This is another example of buying on weakness. That's what we did on Wednesday when it pulled back, got even weaker on Thursday, but closed at the top of the range and back above the pivot by the close. So good action there on GFS. ON continues to act well, bounced at the 21 this week. Boeing, I continue to keep a close eye on it. Volume is really drying up here. Wingstop continues to consolidate. I'd prefer to see it bounce on the 21. I am aware of the rolling over here of the stochastic. Mobileye, this is a classic case that you can't have a 7% stop with a 10% ATR stock. This is a very, very volatile stock. If you bought it on the breakout, you can see this loss here. You were in that area for 3 days, which means you should have gotten stopped out if you follow O'Neill rules. This is one of the changes that we've made. We take smaller position sizes so we can weather wider ATRs like this. We don't just arbitrarily cut at 7%. if it's a 10% ATR stock. So we still got our 3% position on it. I think 2 of the buys are positive and 1 of them is slightly negative. But it does have the potential to be a leader. IBB Biotech, we're using this as a proxy for those 5 big cap biotech stocks that are acting very well, and this continues to look great. Caterpillar continues to had basically a pullback week on lighter volume, nothing wrong there. Arista Networks, we got stopped on this on the gap down day on the Meta news that they were cutting their data center expenses, but ANET just completely shook that off. Volume came in over the next couple of days, dried up now near the highs. If it pulls back again, I may take another shot at it. First Solar, we own this. Anything that's red flagged here is something that we own. Closed on the highs for the week, always a positive. MedP, kind of volatile this week, but not from a volume standpoint. And as is the case with a lot of these, just undercut and reclaim the ADMA. Impinj just continues to work its way sideways. Bounced off the 21 yesterday. CEG undercut the 21, but reclaimed it by the end of the week. AEHR pulling back in pullback mode after this very strong move up from 1760 up to 26. You know it's got to give some of that back. Yesterday would have been a great opportunity near the 21 day to get into it. O'Reilly, tight action. The stochastic came off and now is curling back up. Really tight action. There's such a thing as too tight for too long, so we're going to want to see some money coming into it. But this is one of those stocks that got caught up that down 3.5% day Friday when all of the defensive growth names sold off. This one really didn't get a damaged chart though, so still holding up pretty well. STNG, undercut, reclaimed the 21. Stochastic hooked back up. It's a good story here. Hess bounced at the 21. Steel Dynamics closed above the Livermore mark. It's been going sideways, battling around that area. Very good volume patterns. Look how light the volume's been over the last 3 days, especially the down days. I like the look of this. ExxonMobil bounced at the 21 today. Eli Lilly, couple of tough days there. One of these down days was because of Elon, a Lilly imposter Twitter account saying free insulin, and the stock sold down, but sold down, undercut, and you can see the stochastic has reset itself. And finally, HF Sinclair, aka Dino, or Dino. I wonder why they didn't call the dinosaur Dino in the Flintstones. I've always wondered that since I was a young child, and I still don't have an answer. But anyway, it bounced at the 21 today, as did a bunch of oil stocks. We own ERX, which is a 2 times diversified oil ETF. It also bounced at the 21 today, and that is going to wrap it for the week. As always, love to hear from you. Don at revereasset.com. Comments, questions, or complaints. Actually, just comments or questions. All the complaints can go to Danny. He'll bring them to me if he needs to. Just kidding. Let me know what you think out there. Is there anything that we're not doing in these videos that you'd like to see? Is there anything that we're doing that's just a pain? I had somebody complain about our public service announcement was too long. I've tried to cut that down. I get that you don't want to hear that for 4 minutes every night, but we don't just do these videos for fun. This is a big marketing exercise for us. So got to tell everybody a little bit about us. It's actually amazing how little some people know about the registered investment advisor industry and really what goes on in the shenanigans and the different setups and a broker versus an advisor. But anyway, I'm going to wrap this up right now. So remember, folks, it's not how much you make in the market, it's how much you keep. We appreciate you listening. We'll have 4 videos next week, off for Thanksgiving, obviously. Half day in the market on Friday. I'll still have the video after that. And that's going to wrap it for the week ending November 18th. This is Don Vandenbord telling it like it is. Thanks for listening and have a great weekend.